All right, so good evening. I'm so glad that you're able to make it tonight for this presentation. My name is Cherise Scott. I work with Partner Colorado Credit Union. I am the Member Engagement and Education Coordinator. I handle all of the financial education for the credit union. I am going to put my information in the chat if anyone needs to get a hold of me for anything at all. If you have any questions after we're all done here, or something that comes up later, or just financial education question that you might need to be answered, I am the person that you can go to. So feel free to use that information if you need it. Otherwise, again, I just appreciate giving up your evening this evening with us, from your friends or family or your children, whoever it might be that you're giving your time up for. We appreciate it. And I'm going to hand this off to Larry so he can get us started today. Thank you.
Thank you so much, Cherise. Really appreciate it. She's been great. She's a great partner here. So thank you again, everybody, for coming tonight. Everybody for jumping on the call. I know everybody's time is very valuable. You know, we're getting to a point where everybody's about to have dinner probably. So, you know, I won't spend too much time on this, but thank you again for coming. One of the most important things nowadays is taxes. You know, everybody pays taxes, and the biggest thing is, how do you save on taxes? What's the way to be tax efficient? What's the way to make your portfolio, your investments, everything you do, so you don't get raked over the coals with taxes. Tonight, we're going to come up with some strategies of how to possibly do that. And that's something that some of the partners that I'm working with, I brought in to speak tonight. You know, one is with one of our partners from Fidelity Investments, Kevin Gambale. I hope I said that right, Kevin. And then we also have somebody from Protective Life Insurance that, you know, Henry, forgive me, Blunt. I almost said that wrong. Henry Blunt is here to help as well. So again, we appreciate it. And I'm not going to speak too much. One thing I will do, like Cherise is going to do, I'm going to put my name and my information in the chat box. So I would love to sit down and talk to anybody and everybody about what's going on. There's lots of questions that'll come up after this. And one of the other things you can do if you haven't used Zoom before is to put your questions in the chat screen. We'll see all those and we'll answer them as we can. Or if you want, you can unmute and just kind of jump in. And you know, Kevin's great, and he'll take over in just a minute. So Kevin, appreciate it. Thank you. I'm going to stop my thing and you start yours.
Great. Okay. And again, folks, appreciate you taking the time. It happens all the time where people say Kevin Gambale, it's Gambale. So all good, Larry. But okay. Yeah, I'm excited to chat tonight. I think it's a very critical piece of the investments and your planning that you're doing with Larry. And you know, I had the privilege for 16 and a half years to be an advisor and work with clients. Spent a lot of time educating on ways to mitigate taxes and to defer more as part of your financial plan, and the different you know, accounts you have tied to your goals and your risk and what's important to you and your family and what you're trying to do short and long term. So it all ties together. But what's most important out of all this, having been an advisor for a long time, is, you know, Larry's been doing this for, you know, over 20 years, and, you know, get back with him and just, you know, review your plan and, you know, talk about some of the things that I talked about, see if it makes sense, you know, as part of, you know, what you're trying to do with your plan. So that's the one ask, is hopefully I can share some insight into with some education that can you know, make you a better investor. And that's the purpose of this. So with that being said, I'm going to kind of roll into the presentation that we have, and everybody can see my screen okay, right? So
yes,
why tax efficiency matters, right? You know, especially, at this day and age, there's certain things we can control and certain things we can't control. And one of the things that we can control is mitigating those taxes and making sure you're maximizing all the different ways to do that. Within the presentation, we're going to go over a couple different ways to take a look at that. Big piece of it is variable annuities, and we'll talk about that because that's a growing industry, the trend, and you'll see it in the slide that we've seen. So, but as we just kind of jump into just some basic numbers here that are important to take a look at, is just regular tax rates across, all the different, main numbers here. So federal tax rate, 37%. That's kind of the top rate. Social Security, 6.2. Estate is big at 40%. Trust, 37. Long-term capital gains are 15, or if your income is a lot higher, can be 20 plus state tax on top of that. And then you get into the Medicare tax, which, Larry can spend a little bit more time in educating on different strategies for, tax, means testing and Medicare and all that sort of stuff. So those are the facts with regards to overall tax rates, but they can get pretty high very quickly. So it's important to look at the state specific. Now I'm out in California, so you can see in California, ours are very high. Colorado, you can see right there, that's the state tax rate that you pay. And we'll touch on the bands and what that means with marginal and effective. But just to educate, now's tax time, everybody's doing their taxes. You got the marginal and the effective. And what that means is, you're going to pay a certain amount on certain income levels, which can jump up pretty quickly. But what your true tax rate is that effective rate. So you pay a certain amount on a certain amount of income, and then you pull it all together. And then that is basically your effective bracket tax rate. So you can see the bandwidths and income levels. A lot of the clients that, we work with are, in this world. So you can see your marginal tax rate, maybe 22, but your real effective, what you're paying is 15. And this just kind of shows, the total amount in taxes that you'd have to pay as a result of the marginal and effective. So it's important to know those numbers. It can get confusing, and that's where Larry comes in. Try to look at, where you're at overall with regards to your financial plan and your investments. So as we start at the top, right, first thing we want to do is, and these numbers have changed because this is 2021, but it starts with your 401k and maxing that out. And, basically, as of 2022, it's 20,500. So that's what, you can max out, and, it reduces your income, and you can let that grow compounding over time in the appropriate investments, part of your retirement or accumulation plan. And, that adds up over time, and that gets you to where you want to be in retirement. So making sure that, that's the first bucket. There's a catch up. If you're over 50, you get to put in 6,500. So total, making sure that you're maxing out at, 27,000 total for 2022. And you get into the traditional and the Roths and, the Roth IRA, and there's a catch up of 1,000 over 50. But the Roth is a great way to, put after tax money in there, and it'll grow tax free for the future. So making sure that, you're doing all those things to really max out your retirement savings first. And that's a critical component of the retirement income planning process. So a couple tax strategies just to be aware of. Again, working with your CPA, you're doing your taxes, Larry can help here, but there's converting some, is a strategy if If you know you believe taxes are going to go up, you have a goal of growing that for future legacy or whatever it may be, converting some, not all, but a portion can really help over time and take advantage of that tax-free growth. There's also the backdoor Roth situation where you could potentially set up an IRA, make the contribution, and the next day convert it. It's another strategy. And then you get into tax-free income strategies using municipal bonds, municipal bond funds, and they're very low risk, but making sure that if you have conservative goals, taking a look at tax-free municipal securities as a way to grow your wealth, but minimize the taxes because the income will be federal and state tax-free. So a couple strategies to be aware of. It's a challenging environment, and it has been for municipal bonds because of the low interest rate environment. So it's really critical to really take a look at appropriate municipal bond managers that are shortening the duration maturity of bonds, because we're hearing all this talk rising interest rates as the Fed starts raising rates to keep up with inflation. So one strategy is just make sure you're working with Larry on the appropriate tax-free, if that's an interest, which he can talk about. So that's one strategy. It's part of your overall asset allocation and your goals and whatnot. I think another one that's important here is, when you're investing in, just taxable accounts, right? And there's a lot going on with the positions and, the portfolio, and, making sure that it's managed from a tax efficiency standpoint. And what does that mean? It's, if you buy a stock or a mutual fund, and you've made money and, you've held it for 1 year and a day and you sell it, well, that's long-term capital gains, 15% plus state. But, sometimes you have losses, and, making sure that you offset that when you rebalance, a portfolio is rebalanced. But, there's some real good ways to do that, and just making sure that's minimizing those taxes. And a lot of clients wait to the end of the year and make some changes, but looking at that throughout the year can really help and manage that risk in the portfolio over time. So it's a really good topic to talk about on an ongoing basis with Larry, as the market's changing and things like that. So and we start getting into some more complex, where charitable giving, depending on your wishes and goals, there's some deduction limitations, and you got to make sure that that's appropriate. But there's some ways to do that through donor advised funds and things like that to offset. So that's another strategy that's available if that's part of your goals and your long-term plan and you're charitably inclined. Trusts are tricky. It's very important to work with your attorney or get an attorney and make sure your estate's in order. God forbid something happen with healthcare proxy and beneficiary planning, and make sure that the assets distributed according to your wishes. But they can get a little complex, and depending on the structure, the taxes go up really, really fast. That's just the way they're structured. So a lot of benefits, but making sure that it's aligned with your goals, and you're not paying extra on an account that you could be shifting to another vehicle, which we'll talk about that as we move through the presentation. So now we start getting into non-qualified deferred annuities and some of the benefits of them, of those vehicles, because essentially you could take after-tax money, set it up in a non-qualified deferred annuity, and the benefits there is you get a lot of flexibility. There's no contribution limits. If you're over 59 and a half, take withdrawals. If you're in a lower tax bracket, when you know, when you need the income. And there's no required minimum distribution. So 72, when the government requires you to take money out of your qualified plans, you know, these are very attractive because you can let them keep growing, compounding over time. And then as the market's changing, you can rebalance in those. So they're really, really interesting vehicles if it's appropriate for you and it's part of your long-term plan. So we'll touch on that a little bit later, but this is just shows you the power of tax deferral. You know, as planners and advisors, we really preach, you know, compounding over time while you're working and getting that wealth working for you, you know, because it adds up over time. And this shows just a study, you know, over time, you know, how long does it take for your money to double based on rates of return, and you know, whether you're in a pre-tax account, a tax deferred account, or it's fully taxable. But you can see, you know, as you kind of go this way in the slide, you know, your money doubles faster, you know, with a higher rate of return if you're in your accumulation phase and it's managed properly in a tax deferred account, to potentially, you know, retire earlier and you know, do the things you want to do in retirement. We spend all the, you know, 40 years, 30 years plus working, and we want to be able to do things after, and this can help get you to that sooner, working with Larry as part of your overall plan. So kind of just shows the returns and what you need to achieve, and you can see, you know, over time it adds up. So that critical component of the overall deferral conversation. And so this is very interesting, you know, because we've seen this shift over time. You know, going back to 2008 is the need and the want and the benefits of these low cost tax deferred annuities, because of that compounding growth over time. And you know, I played hockey growing up, and you know, going where the puck is going, but you can see this trend just continues to go up. And, you know, these different annuities that are out there through Henry's company, and, you know, they keep coming out with more investment options and more benefits over time, which is critical as you're looking at, you know, how do you maximize your retirement, you know, given all the different ways that you can invest, you know, through Larry and through some of the maybe other advisors that you work with. So big shift that we're seeing, and we only see it continuing to trend upward. So, you know, it's a very, very interesting slide that shows that. So hopefully that helps in the discussion of you know, where you want to go and options available. This is really where, you know, kind of the main piece of this is, you know, who can benefit from the most tax deferral over time. And if you got 10 years or more, right? If you've got large taxable accounts, and, you know, it's really interesting because last year, as I'm looking down at my page, there were 126 mutual funds that paid over 20+% in capital gains, right? That's money that is going right to the government, right? There was over 31 funds last year, mutual funds, that paid over 30%. So, you know, as you're looking at, you know, your portfolio, you know, I'd encourage you to get back with Larry and really look at some of these positions and see, you know, does it make sense to even have these in these taxable accounts because of the capital gains, and maybe shifting some things around. And then obviously you get into your marginal, if you got a high marginal tax bracket, but if you truly believe that you're going to be in a lower tax bracket when you retire, or maybe you leave Colorado and go to a state that has no taxes, that's a huge benefit to looking at these type of vehicles. And then, you know, we start talking about the tax inefficient assets, which we'll, you know, take a look at in the next couple slides, that, you know, really Larry can help you dig in deeper under the positions because what we found over the years, whether you worked with a previous advisor or invested on your own in the past, or whatever, there's inefficient assets and investments that could be moved around a little bit to just minimize those taxes. And I'll educate you on those so you can take a look at what you own, have a conversation with Larry about that. So, and that's what this is, because as you go, where are the most efficient assets to hold is, mutual funds and investments that have high turnover, right? High turnover creates a lot of capital gains that get passed through. Mortgage, bond funds, they're great to have in your 401k, or IRA, but get them in a taxable account. You pay an ordinary income, which is your tax bracket on that. Corporate bond funds, leveraged loans, high yield, emerging markets, those should be moved into, whether it's a 401k or an IRA or a little bit in a Roth, just to minimize those taxes. And, as you take a look at the other slide, equity funds like REITs and those are going to be more efficient. The tax managed, equity funds, separately managed accounts. And then in the middle, you have, treasury funds, which you pay federal tax, but no state. And, some equity funds have qualified dividends and whatnot. So, it's really important to look at those across the account, make sure that, we call that asset location. Where are you locating the assets? Are they in the right location for the different accounts, Roth, 401k, IRA, annuity, taxable? So, that's what Larry can help you with, taking a look at, your positions across outside accounts and, internally, whatever. So, this slide is really interesting because this really talks about, the tax drag, we call it, how much over time is dragging down, a taxable account based on equity and fixed income and allocation, and what's really interesting is this piece, because when you work with an advisor and you put together a balanced portfolio or growth with income or growth or whatever, that's an asset allocation fund. But what we found through our studies is, this number is pretty high for asset allocation funds and asset allocation portfolios. So, there could be a lot of things to do there to minimize that number and still keep the allocation that you're comfortable with. Balanced, moderate, conservative, growth, whatever is appropriate based on your time horizon. This right here, this is more of a Morningstar tax tool. Just kind of talks about management fees and, what's the 3-year, tax cost ratio and the capital gains. And, it just kind of pulls it all together. And again, goes back to that, consider relocating these tax inefficient assets over time into other vehicles. So just a tool that's out there that basically just validates, what's been going on with taxes and investments. So this is where we start talking about identifying, opportunities, anything trust related, depending on, the beneficiaries. And again, that tax rate jumps up pretty high very quickly. Reducing, the basically fees, and, if there's, outside, investments that have, living benefits and things like that maybe were purchased when the market was down, or you don't need that anymore. There's ways to, upgrade it and keep the tax deferral going, in a different vehicle as things change. But a big one is gaining control, of that taxation within those investments. And then you start getting into, different legal terms and protecting the assets and creditor protection, with some of these vehicles that are out there through, Henry's company. And then the potential death benefit that's part of, that type of offering that Henry has. So just some opportunities to look at, different ways to consider variable annuities and life insurance as part of your plan and part of your overall goals and wishes and needs and what's important to you. So bigger picture, this kind of talks about, how multi-manager platforms allow for exchanging between fund families and, breakpoints and loads and things like that can be removed if you're in the appropriate vehicle. Really making those changes. There's a lot of volatility in the markets, and where I did a lot of work for a long time at Fidelity, helping clients, and it gives the ability to make those changes and not have to worry about, oh, am I gonna have a gain? Am I gonna pay taxes? I want to move money into different areas to complement, sector exposure, part of the model, whatever. So just some real good benefits to these type of solutions, which can, again, help you get to that longer term goal faster, so you could do the things that you want to do, that are important to you. So I think at the end of the day, making sure that you're taking a look at all the different ways to make sure you're maximizing the tax deferral, the tax-free with the Roth, relocating assets, inefficient assets, as part of your longer term plan, and making some changes that can help you over time, that can be really critical in that partnership with Larry. So this kind of gets into, holding a variable annuity within an IRA. There's some pros and cons, and when you think about, 30 years of saving in a retirement plan, and, working at the same company, the ability to, depending on the Social Security, when you're going to take it, and, other assets that you have, taking a look at, sometimes it makes sense to defer Social Security and take a look at an asset and put some protection on it and generate income there in case the market does go down, and take advantage of the maximum benefit in Social Security. So, there are some benefits to that, which, Henry could touch on. But, also, you got to make sure that you're in a low cost or medium cost, vehicle to help you do that. So, there's some vehicles that have been out there for a while that maybe have higher fees. So, that's where Larry comes in and can really show you the options that are available to help you get to those goals. But it is a lot of benefits to taking a look at that for an IRA for protection and guaranteed income in the future to complement Social Security. This is what we're talking about with trusts. So this is, these right here are very complex trusts. There's a lot of different ways that, you can set up different types of irrevocable trust and generation skipping trusts and special needs trusts and, A and B and marital trusts. But you can see that this number jumps up really, really fast on what's kicking off in the portfolio. So, as an advisor, I always would try to minimize that. So, we want to defer that as long as possible, minimize those taxes. So, and that's it. So hopefully, that was educational and helpful, and, I'll take a couple of questions and kick it over to Henry to talk. But appreciate the time.
Excellent. Well, thank you very much, Kevin. For all of you that haven't met me yet, my name is Henry Blunt with Protective Life Annuities. And I think the biggest thing that you should take from everything that Kevin went over, because it's fantastic information. We know we have tax season coming up, a lot of different things happening inside of the world. And that's why it's always a good time to come down and sit and talk to Larry. Larry's an individual who I look at him like a coach. You have many different teams. You guys are the franchise owners. He's the coach. When people say they have people, what Larry's talking about are individuals like myself and Kevin. You're gonna sit down with Larry. You're gonna go over your unique financial situations, and he's gonna figure out which players he needs to put on the field to get you the most bang for your buck, or to get you to the point that you want to be at. Many different ways to use different types of variable annuities, tax saving plans, qualified plans, and that's what Larry's going to be able to help and guide you to along the way. So at the end of the day, Larry's the individual who's going to help with those situations. And if we're so lucky to be chosen, we're going to be the individuals that represent the companies. With inside of the variable annuity, you have fantastic options with death benefits, a way to continue to defer taxes and other things to that situation. With that said, I'd love to pass it back over to Larry. And Larry, the floor is yours. Thank you, everyone.
Hey, thanks, Henry. Thanks, Kevin. Hey, I really appreciate it. You guys are always great. And again, you guys very knowledgeable on what you do. And just let everybody know, Protective Insurance is a phenomenal company that has the annuities, and Fidelity has some of the best funds that are in the annuity. And it's funny because the term annuity, in the past has always been kind of people are like, I don't want an annuity, but typically what annuity is, it's kind of changed over the years. It's very low cost. It's more of a tax deferral type thing. And it gives you a lot of extra benefits that you can't get outside of annuity. It gives you the death benefit, which means that if you die, your family gets a higher amount. Also, there's benefits that will pay you income, almost like a personal pension for the rest of your life. And Protective has some of the best ones out there that I've seen, and they're very low costs for what they give you. And, there's a value why people get into these. So what we can do is figure out each situation for everybody. It's different. Everybody's unique, and we can tailor it to you. And that's something I'd love to sit down. Now, I did put my name and phone number in the chat. If anybody wants to go look at that, you give me a call and we can sit down. There's no fee for me to sit down and talk to you. So if you want to have a meeting, I'd be more than happy to do it. And then we can figure out what's the best strategy for you guys. And there are a lot of investments that are tax efficient, and we have plenty of stuff to talk about and to figure out what's best for you guys. So again, thank you. I'm going to let everybody get back so you can go have dinner or get back to your night. Appreciate it. And again, wanted to thank Henry, Kevin, and Sharice. Appreciate it. And give me a call if you have questions, guys. Appreciate it. And anybody else have anything to say, or did anybody have any questions?
Yeah, I want to open the floor up if there's any questions. Definitely, while you have Kevin, this is the time now to ask them. Right, it doesn't look like we have any. So Larry, thank you so much. Henry, so much. Kevin, I appreciate the presentation. It was great information. Thank you all for coming this evening, and thank you for those members that took time out of their schedule to join us. And I hope that you got some well-needed information from the presentation today. So have a good evening. Thank you all so much.
Thanks, guys. Appreciate it.